Good morning, everybody. It's Tuesday, August 17th. I can believe that we are starting our fall and the tax extension season is upon us, and the kids are going back to school, and life is starting to have a bit of a routine again. But we're back with our Tuesday morning webinar. Today, I am joined by our wonderful business coach, John Seiffer. John has been working with Koontz and Parkin and Koontz and Associates for the past several years, helping us build our businesses better and grow more intentionally and do things right. And John and I have been teaming up to bring you guys a couple of good webinars. Our latest has been several sessions on cash flow, why cash flow is important, how to read financial statements, what do the financial statements mean, how to make them more useful to yourself. We were on a couple of weeks ago talking about cash flow statement versus income statement and balance sheet, and had a great tutorial on how to read and prepare the cash flow statement and how to make it more useful. So today we're going to be talking about how to make your income statement be a little bit more useful as a business owner to read it. So I will let John kick this off, and then we will look at a real life example.
All right. Thank you very much. I want to be on this screen. So we've been calling this the F word for business owners, and the F word stands for financials, because that's how most business owners that I know who don't have accounting degrees think about this stuff.
Very true.
Yeah. And today we're looking at the income statement, but the way I look at it is, here's your company, and your company only needs to do three things to survive. It needs to make something that people want to buy. It's just providing value for your customers, whether it's a product or service. You need to find those people and sell to them. And then you need to support the making and the selling, usually by building a back office or some kind of organization. This is keeping the lights on, paying the bills, collecting the money, getting the facilities working, keep the machinery running, insurance, compliance, all that kind of stuff. And the problem is that, oops, I don't know why that skipped. The problem is that most financial statements tell you what you spent money on, but not why you spent it. And so if you had a line in there that says travel, do you want to do more? Should that go more or less? Mm-hmm. Well, if you travel to make sales, you want to do more of it. If you travel to solve problems, maybe you want to do less of it. And so that brings up the question, why spend any money at all? And you spend money just the way your customers do because you get something of value in return. And that value should be grouped into one of those categories of making, selling, or supporting. And so I have this little diagram where the yellow box is your company, and the sales is the money that comes in from customers, and the other boxes are the money that you spend and the reasons that you spend that money, and what comes out the bottom is profit. So the reasons that you spend that money are either what's called COGS, which is cost of goods sold, which is why you spend that is to provide some value to your customer. It's the things you buy that make the value that customers pay for. CAC stands for customer acquisition cost. That's a terminology used in the tech world in SaaS businesses, but it applies anywhere. And that's the money you spend on marketing and sales. And the reason you spend that money is to get customers. The operations is the support function that we had in the earlier slide. And that's, you spend that on the overhead to keep the lights on, basically. And then there's one other category, which is payback, which is paying back any startup or loans that you have. And you spent that loan money on one of the other three things, but now you have to pay it back. And then typically you look at this and you go, oh, profit, that's great, because you think that profit is all going to go to the owners, which is the whole point of being in business, is you're going to make some profit. There's another piece that I will get to in a little bit, but before that, I want to turn this over to Marina, because she's going to take the favorite pet veterinary clinic numbers that we did before and show you how to apply some of this insight into that. And then I'll show you a little bit about why this doesn't always all go to the owners. So let me stop sharing my screen and I'll turn it back to you.
Awesome. Thank you, John. So let's do this. Here we are. So let me first go back to kind of refresh you guys' memory. This is our favorite vet clinic that we had looked at, for example, of financial statement, income statement, balance sheet, and cash flow. This was the original P&L here, which started, just a quick refresher, started with our service income, some of the product sales, what the client had classified as cost of goods sold. And then we had all of the other expenses that were not classified as cost of goods sold, just in other operating expenses. And here you are. So we had about $308,000 of cost of goods sold. We had another $947,000 in all other expenses. And then we ended up with net income. So as I said in the first time we had looked at this financial list, for me as the tax person, this is beautiful. I can put that in the tax return. Everything I've already reviewed is deductible. Everything is great, and I can keep going. But now let's see how we can better organize it so we can look at the different categories. So what I did here is in this tab, I had reorganized them. So I set them up just according to the categories that John suggested, which is cost of goods sold, customer acquisition cost, operations, and payback. So what I did here is I said, all right, let's scroll down below income and start with the cost of goods sold. So I looked at the section that the client said is their cost of goods sold, and I agree, all of those are cost of goods sold. So let's assume they're okay to stay in that section. Then the real work began here when I got into the all of the other expenses. And then I really had to give it a little bit of thought and said, okay, what am I doing and why am I spending this money? So the advertising and marketing was, in my opinion, customer acquisition costs, so that I put it there. Then we had a lot of just general sort of fixed expenses, and those expenses were just necessary to run my business. So I got bank charges, I got some computer expenses, I have my regular dues, I have to lease the equipment, and my business has to have insurance. Now I get to some of these costs. For example, the first one I stumbled into was health insurance. And that kind of went along, if you look below here, with my payroll expense and payroll taxes. I said, all right, well, how many of my employees are actually performing services versus running the business? And I said, well, in this particular case, let's assume that 70% of the employees in this vet clinic are professionals performing the vet services. And then 30% is the admin staff. So I said, okay, let me stick to that idea and split the health insurance that I pay for my employees, the general payroll expenses, payroll processing fees, and payroll taxes to 70% as professional staff, and that is cost of my goods sold. So that is really, the professionals that I need to earn that revenue. And then 30% went into just general operations. So that would be my office manager, maybe my front desk person, stuff like that. Then I went even further in my payroll cost, if you can see. And I said, all right, out of the 30% of my admin staff, do I have a marketing person, or do I have somebody splitting their time and doing some of the marketing and advertising for my business? And the answer is yes. So in this case, I assumed that I had a $30,000 individual who is doing marketing and advertising and maybe some social media stuff for my business. So I further split out the salary of the admin people to office administration, just strict administration, and then the customer acquisition cost here. Now, I didn't go as granular into the payroll processing cost or the health insurance, but I could, if I wanted to split out this person's payroll processing fees in here and the health insurance in here. For the purposes of this exercise, I think you guys get the idea. so I kept going, and then I stumbled into the interest expense, and I said, well, that's me really paying back the loan that I took out to buy this business. So let's shove that interest expense into the payback section. Kept going with my general operation. Further down, I stumbled into an officer compensation. And the officer compensation is, I really had to think about it a little bit more to realize that the owner of the business, in this particular case, let's say, is also doing some professional work. So they're also performing some vet services. And then also, of course, they're running the business. And also, of course, they're doing advertising and marketing. And of course, they're wearing all hats, right, John? That's the way we do things.
Right.
So in this particular case, I said, let's say that 20% of the owner's time is spent doing the actual work in the business, and 80% of the time the owner is spending running the business. So I said, okay, let's say the owner is getting paid $80,000. 16, which is 20% of that, is the cost of sales. So that goes along with all the other professional staff. And then the rest of the owner's time, I just made the assumption, is really split between running the business on admin side and then doing the outreach, marketing, advertising, and stuff like that. So this is, again, the assumption that I make, and you can make a different assumption in your business because every owner at different stage or different type of business does different things. So I just wanted to show you guys kind of how I did it. Also notice that the owner compensation is not in the payback section because the owner distributions, when we're left with some money, right, John, hopefully there's money left, that's what the owner can take as the draw, and that'll be their payback. We're really focusing on the owner compensation in this case. It's really for the owner doing the real work. So if they hired somebody else to replace them, then that would be somebody else's compensation here.
Yeah.
But
So one of the ways that I say that to clients is what you earn for what you do is your salary, but what you earn for what you own is the profit that comes out. And
that's
for tax purposes, you can set it up one way, but for understanding the business, if you stopped earning, if you stopped doing the work, you would have to replace yourself. And what's the market cost of replacing yourself? That's where you should be thinking if you wanted to scale the business.
That's exactly right. And actually, when we talk about the IRS and what the reasonable salary that IRS wants the owners to take, it is very much one of the tests is based on what would it cost you to hire somebody to replace the work that you were doing as an employee. And that becomes kind of the basis of how much the salary you would set yourself. So as much as you say, I want to save on payroll taxes and I'll just take out, $20,000 for salary and everything else is drawn. Well, of course, the work you're doing is probably more valuable than a $20,000 in a year. And
when companies are really small, no matter what the accounting numbers say, a lot of owners kind of think of their time as free. And they say, well, I could just put more time into this or more time into that. And that attitude keeps the business small because at some point, there's only 24 hours in a day and you can't work all of them, and at least not every day. So you have to hire somebody. And then you start saying, well, that's expensive. Well, of course it's expensive, but if your business is set up right, it's an investment that pays off. And you were actually investing that time, even if you weren't investing the money. And you have to switch your attitude in order for your company to scale up.
That's exactly right. And in this case, I was very happy with the level of compensation that this owner took. And then of course she took some draws as well. So let's see, what else did we have to split out? We had our merchant services fees, which of course were related to the credit card charges. So we put that as a cost of sales. And again, we split our payroll tax, we put rent in the operations and all the repair and maintenance, sales tax, and the medical equipment. The medical equipment did make it to cost of sales, but we really did need to buy it to keep performing our services. So I did add that to the cost of sales, as opposed to kind of office supplies and stuff like that, which we put in the operations expense. So, of course, making some assumptions here, but you get the idea here. keep going, put our phone and our taxes and licenses in the operations, and then get to the website expense, and we put website as the customer acquisition cost. So when we get down to the bottom, we've tallied up every section and we said, all right, so really the client started with cost of sales of 308. But if we are really to do it right, our cost of sales is about $670,000. Okay, so that's how much it's costing us to generate that revenue. And then we spent about $82,000 on customer acquisition. We spent $460 or so on operations. And then, of course, based on the income statement number, part of the payback is just the interest expense, which is $40,000. So as you can see, I've kind of captured all my expenses in the categories. So what I really wanted to add is you guys can take it even further and say, all right, maybe now that I've got my income statement, let me bring in some of the cash flow items that I have in my cash flow statement. Let's switch back to the cash flow, which again, we looked at last time. The cash flow is really giving us a couple of different sections and says, all right, the owner took some draws. We also paid back some of the bank loan. We paid some of the credit cards and such. So if you really wanted to, you could take this section of the owner drawn bank loan repayment and you can add that to this payback section. So where you're not just looking at the income statement, you're really looking at income statement and the cash flow statement together. So you can kind of create a statement to say that. So I think that's another option. One of the things too, that it may be a little bit hard to do when you're doing the split is the payroll. John and I kind of went back and forth a little bit on this and said, well, if how often do we need to be doing this split for us to get a good analysis of our financials? Should we be doing this every time we make a payroll journal entry, or should we be doing this on quarterly basis or monthly? And I guess the answer is as often as it's useful to you when you're looking at your financials. So the issue becomes is, let's say you've got your payroll reports from ADP, who's running your payroll, and you're setting up the entry based on the ADP reports. You're not going to set up every other biweekly or weekly payroll entry to say, okay, well, this is going to be this kind of position, or this is sales. Although in larger companies, you do have that. You do have different subcategories to labor. And if you do have a bookkeeping clerk, they will split out the journal entry. If you're a small business like this, you're probably going to record one entry every time you get a payroll report. And then maybe if you do this kind of analysis quarterly, you can go back and use your allocation percentages and just say, hey, let's just split up this quarterly payroll into cost of sales versus operations versus marketing. So again, it's whatever, we don't want you to spend time every week to try and do this, but whatever it's useful to you guys in terms of performing this analysis.
Marina, can you make that a little bigger so people can see the numbers? Like just scroll that up. One of the things, like a kind of a back of the envelope way to think about your cost of goods is to say, if I increased my company by a factor of 10, if I had 10 times as much sales, which of these costs would also go up by a factor of 10? Obviously, your rent's not going to go up by a factor of 10. But your merchant fees, in this case, your credit card fees would. Your some of your payroll would, because you'd have to have 10 times as many people doing that work. The small medical equipment would. So that's like a back of the envelope way to think about it. The other thing, from thinking about why you spend this money, now you can look at this and say, okay, this company spent $82,000 on marketing and sales. Did they in fact get enough customers for that money? Did they spend it wisely? Did they get the value that they were expecting? Or did they just go, well, we do this every year. We put the website up, we do this, we pay for ads, we blah, 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 and didn't take a look at, is this really where we should be spending the money? I have a client who did this analysis and said, wow, I'm spending $90,000 on just this part of their customer acquisition costs. Didn't think they were getting anything for it. So they stopped. They were still spending other parts on advertising and things, but they just saved $90,000 and said, okay, now I'm going to see what happens. And not much happened. So they said, okay, where can I spend that 90,000 or some portion of it and get better results? And so now they're doing it that way. By looking at these 4 categories, you can say, here's why I spent this. Am I getting what I should for it?
Well, and to go along with that, John, what you can do is, again, if you want to get even more detailed and granular here, you can take this area, you can take this section, and you can create subcategories. So instead of saying, okay, it's $12,000 that I spend, you can create sub-accounts that says, my Facebook ads or my mailers or, my putting an ad in the local magazine, stuff like that. And you can track them by type as well. In terms of your split, it won't affect it. So you'll still put all of these subcategory expenses in your customer acquisition costs, but you can definitely track it by the subcategory, and you can get as granular as you want to where you, based on the things that you really want to track. And I think advertising and marketing is, we see that quite a bit, where we tell people it's an easy kind of area to dump things. I don't know what it is. I bought some promotional stuff. Let's put it in there. Well, and that's okay. But if you're trying to be intentional about how much and what areas you're spending, and you want to create some trend and analysis about where those spending and if they have a relationship to your revenue, then definitely you want to have some subcategories there.
Yeah, and you can do that in 2 ways. What Marina did here was take the QuickBooks report and export it to a spreadsheet. And then she did all the moving stuff around in the spreadsheet. In some cases, you can actually reorganize your chart of accounts in QuickBooks to give you subtotals the way cost of goods typically does. And so you can group things. Obviously, those are usually marketing would be a great one for this, although wherever there's payroll, that makes it a little tricky. So when you have to divvy up your payroll, you probably want to do it in a spreadsheet.
In some businesses, in this business, we really don't have a huge expense, but let's say meals and entertainment. In some businesses that tend to take their clients out a lot, or their colleagues, or do a lot of travel, this is another area that you want to split up. So let's say, why am I eating? I'm eating with a customer, I'm eating with my colleagues, or I'm feeding my staff, or we're having a meeting and it's a lunch meeting. Again, depends on the kind of business, and whether I would kind of take the bigger categories of expenses, and that's where I would kind of do the split. And something where you feel like, I kind of want to know what's in there, those are the ones that I would go and further subcategorize. Because I think you will also find that, let's say back to meals, is again, that meals, you would be able to split it between, if you're doing it as part of the advertising, or it's just part of operation, this is your just, weekly lunch or whatever, or Christmas party that you're giving to the employees. So I think that you can definitely, and whether you set a certain percentage, like if an expense is a large percentage of revenue, maybe you set some sort of threshold and say, I want to look at this one a little bit more because it's, 3% of my revenue, and maybe I care about it more. And so it really is, I guess, based on how useful things are. But I think this is a great way to really identify, because now if you're saying, okay, my cost of sales, this is great, I generated 1.3 million in revenue and only spent 300 to do it. Well, no, you didn't. You spent 700,000 almost to do it. So
and you hit on a very important topic here, is when you're doing this analysis, it's fine to do ballparks. You don't have to do it down to the penny, the way you do obviously for taxes. But you can say, well, I think 20% of the owner's time is spent on this, and I think my professional staff is split 70-30. Well, maybe it's 75-25. That really doesn't matter if it's down to the penny. You get a gist of, am I spending? Why am I spending this? Am I getting what I hoped to get for that spending? So.
Yeah, absolutely. So I think this is going to be useful to quite a few of you. And You know, you can, again, you can set up a lot of the subcategories directly in QuickBooks. You can further bring the analysis and do that in Excel. If you guys do want to bring in the cash flow stuff to it, then I think you do need to manipulate some stuff in the Excel, because QuickBooks is where you're going to have a little bit of delimitation in doing that, which is fine. You can start kind of with your income statement. And again, on the bottom here, you can bring the owner draw, I would put in here, and payback of the loan, I would put in here. And then you really are approximating this cash flow to the income and saying, you know, this, I brought in this 1.3 million, and what the heck did I spend all of it on?
Where did it go? Right. I had a company once where, for tax reasons, I needed to have certain things on the balance sheet and certain things on the income statement. But for some of these reports, I wanted them mixed together. So what I actually did was I set up a second company in QuickBooks, and every month I would generate reports from the first company, and I would make one transaction in the second company that was kind of this weird hybrid. And I never, you know, as long as there was the same dollars, I could get my reports very quickly the way I wanted them. That was one way to do it. So, but this is really important to know why you're spending this money.
Yep. Yeah. So hopefully this is helpful. So John, I can hand it back to you.
Okay.
Okay.
All right. Let me, what I said before was this, I really think of the company in terms of cash flow. And so this is where the money comes out. Now, part of that is because if you have a company where you spend, most of your customers are businesses and they don't pay you on time, and they pay you 30, 60, 90 days. It's important to know when your cash is coming in and when your cash is going out. And so that's why I kind of think of it that way from a business perspective. And these are kind of cash flow ideas. And what I said was, you hope that all the profit is going out to you as an owner. But one of the places that you can also put that money is to put it back into the company for growth. And what that means is you are still spending it for these 3 reasons or 4 reasons. So maybe you're getting a loan to increase your operations, that increases your payback. Maybe you're spending more on cost of goods, meaning you're hiring people to do more vet work. Or if you make widgets, you're getting a new machine to make more widgets. So you're increasing your capacity to do one of these. You're maybe hiring a new salesperson. Well, obviously you want to keep these in balance. You don't want to spend money making product that you can't sell. On the other hand, you don't want to spend money on a salesperson who will sell something that you can't make. So if you do put money back into the growth, it's still these reasons, but it's in a slightly different category, because you don't need to spend that money to keep the business solvent. You need it for growth. And that's another kind of subset. So if you remember last time, I gave you this spreadsheet to calculate your cash flow needs, and you can put all your the money coming in categories in the green section and the money going out in the red section. If you're a real glutton for punishment and you really want to do this deeper, I've got this more advanced spreadsheet that I can send you, which has the same things. I included here the weekly cash flow across the top, and then it turns monthly for a while. And all your cash in is in this white section at the beginning. And then you break your cash out by reasons. So the yellow is for your COGS, cost of goods sold. Your orange is for customer acquisition. Your green is for the overhead. The pink is for the payback. And then if you really want to get granular, you take any money that you spend on growing the company into the blue section. It's a lot of work and not always worth the effort, honestly, but sometimes it is, to really give you an idea. And then this will calculate, here's your beginning cash on hand and your cash at the end of the period. And that could give you an idea when you want to spend money, for example, on growth. Do I want to spend it this month or maybe this other month? If you'd like a copy of this, send me an email, john@ceobootcamp.com. Tell me what you're looking for. I'll be happy to send that, and there's a whole sheet of instructions that goes into a little more detail than I had now. So that's my take on this, and I'll turn it
Wonderful.
back to you.
Thank you so much, John. Yeah, this is great. And, you know, I find that more and more my clients that are kind of interested and finally get their tax life in order. In other words, they're not behind in taxes. And once your tax returns are done timely, you do find that you have a little bit more time to focus on what does all these numbers mean to me. They're not just to shove in a tax return. What does it tell me about my business? Particularly, I noticed that, John, when people are kind of going from one stage to the other, where, you know, they've hired somebody or they feel like they're overwhelmed with work and they need to, and it's like, oh, does that make sense? So that's when they tend to kind of do the analysis or say, you know, I'm moving to a different location. Is it worthwhile buying this building or undertaking this rent, or what am I doing? So anytime I think there's a big shift, people tend to kind of look at the cash flow and look at the budget and figure out why the money is being spent and want to track it. So we do get asked a lot more and more on the advice on, am I doing this right? And you know, there's no right or wrong answer, but I definitely love to be there and you know, put my 2 cents in and say, yeah, this at least let me help you prepare these financials, and let's look at them together and see what numbers it can tell us. So that's definitely something that I love doing, and John does as well.
I do it not from the numbers aspect, but more from the conceptual aspect of it. And so it's a great pairing of how do those numbers reflect what you're actually trying to accomplish, and because the numbers really tell the real story. So.
Absolutely. Well, thank you so much, John. Thank you, everybody,
My pleasure.
for attending. And as always, our webinars are recorded. They will be posted within about a day or so on our YouTube channel, on our Facebook pages, and our websites, both koontzparkin.com and koontzassociates.com. And we will see you next Tuesday with another fun legal related topic, I think. And Joanne will be there to give her 2 cents about that. And John and I will be back in a few with some other exciting financial analysis topics. So thank you, everybody, and have a great week.
All right. Take care.
Bye-bye.